Hey everyone, thanks for joining. We're just going to give 90 seconds or so to some of the stragglers still coming in, but hang tight, we'll be getting started shortly. Alrighty, so we'll get started. Thanks again for everyone that's joined. We're really excited about the topic that we're talking about today. As you know, we're going to be covering the different valuation estimates that are calculated in the BizEquity report. So we'll go over the definitions behind each, the calculations, and then specific use cases. So definitely an area that we get a lot of questions about in support. So we're really hoping that everyone can leave the call today feeling a bit more confident around this topic and able to have more impactful conversations with your own clients. So I'll introduce myself. My name is Marie, and I'm our Director of Client Success at BizEquity. And on the line here, we have Ryan, and he is our Director of Valuation Support.
Hey everyone, happy you could make it.
So Ryan actually joined us recently, and if you've been lucky enough to work with him, you'll realize he's been a great addition to our team. So he's been working with us closely to help bring some more of this valuation knowledge to our clients and make it easier for you guys to understand some of these topics and speak about them with business owners. So keep an eye out over the next few weeks and months as we release new knowledge, but we're really excited to have him. So a couple of housekeeping things before we get started. So we hope you don't have to jump off early, but if you do, that's fine. We will be recording this call and sending it over in a follow-up email. We will also be including this presentation deck that you'll be following along with today, as well as our brand new white paper titled Understanding and Utilizing Your Client's Estimates of Value. So this is exclusive. You guys are getting the first look at that, and we're really excited. Last thing is you'll notice that there is a chat box in the GoToMeeting part of the webinar here. So if you have any questions throughout this call, please feel free to send them over. We will be saving time at the end to go over those, and we're welcome to any feedback. And let's get started. So on our agenda today, we're going to first cover the different four valuation estimates that you see in the report, and then we're going to specifically dive into each of those. So we'll go over the asset sale, equity, enterprise, and liquidation values. After that, we'll be covering the difference between an asset sale and a stock sale. And lastly, we'll go over some of those questions that you've sent in, as well as just a brief conclusion. So without further ado, I'll hand it over to Ryan.
All right, and thank you, Marie, for the introduction, and hello again, everybody. So, we'll get right into it. So, many of you here are familiar with the software and that it generates four estimates of value based on the inputs put into the software. And now each of these values is going to have its own, characteristics and use cases. So we'll dive a bit into each of them and, hopefully give you a better foundational knowledge of, what's really making them up and when is best to use them. So we'll go ahead and start with the asset sale value. All right, so here we have the asset sale value, right? And as the name suggests, it's going to be the value of the business during what is known as an asset sale transaction. So in an asset sale, basically an incoming buyer is going to come in and purchase the individual assets of the current company and place them in their own newly formed entity. By doing this, they're basically starting with a clean slate and they don't have the same potential liability concerns from the previous company. Now, this is going to differ from a stock sale. So if you're selling your business under a stock sale, This is where the incoming buyer is going to purchase the equity from the current owner, and really they're going to be stepping into the current owner's shoes. So again, a stock sale, you're basically just replacing the current owner, but you're also going to absorb their liabilities, both known and unknown. So a little bit more risk there. We're going to dive a little bit more into the differences between asset sale and stock sale toward the end of this presentation, but just wanted to give a high level. So now we have the asset sale value, right? So how is it calculated? How are we getting to this asset sale value number? Well, for most companies, the software considers a hybrid approach of the income and market methods to valuation, where we first calculate what is known as seller's discretionary earnings, right? It's a measure of cash flow. And then we're taking that cash flow and we're going to apply it to an industry specific multiple that's also size, risk, and growth adjusted based on the inputs put in for the company. So we have the cash flow, we times it by a multiple, we get to a final value, right? So this is going to be the asset sale value, or the value of the business as it would transact under an asset sale. Now, the next logical question is, all right, we have the asset sale value. What's actually included in that asset sale value? So, if we look to the definition here on the slide, it's going to include the inventory, the furniture, fixtures, and equipment, basically the fixed assets of the company, as well as the intangibles. I would just point out that the intangibles is going to include things like goodwill, customer list, trained assembled workforce. But the asset sale value is not going to include cash, accounts receivable, liquid financial assets, or any of the liabilities, as those are going to remain with the seller. So again, typically when we transact under the asset sale, we're going to acquire the hard assets of the company and the intangibles, but we're not going to be purchasing their cash, AR, or taking on any of their liabilities. So naturally, some users will go to a company's balance sheet and they're going to attempt to add these things up, right? Maybe you go to one of the companies you're valuing, you take their balance sheet, you find the inventory, the furniture, fixed assets, equipment, things like that, intangibles if they have any, you add them up, and you're going to notice that it's vastly different from the asset sale value that's getting calculated by the tool. Well, a couple reasons for that. One, on a balance sheet, these items are typically recorded at historical cost, so the cost of what the current owner paid for them. And then also, it's not really, a balance sheet isn't going to capture the intangible value, right? So that goodwill, that trained assembled workforce, it's not going to be on there. So really the asset sale value represents the fair market value of all these assets in the definition. And really just to kind of hammer it home, if we think about an example, let's say, you have a client that has, $100,000 of fixed assets, right? But the asset sale value is $1 million. Well, naturally, an owner is going to, wonder why is somebody willing to pay $1 million for my business if I only have, $100,000 worth of stuff, right? And it's because there's the intangible aspect, right? So you have the assets, the hard assets, but you have business processes in place. You already have a workforce that's doing the work. You might have intellectual property. You have a customer base, recurring customers, things like that. So all of those things together are really going to get you to the overall asset sale value. And then obviously the next question is, when would you use this, right? The asset sale. So again, as the name suggests, if you're transacting, so selling or purchasing a business in what is going to be an asset sale, then this is going to be the value you're looking at, because it includes all the components of a traditional asset sale. Another good way to use this is, monitoring, your clients, the value of their company over time, because, you have an apples to apples comparison over time of the actual value if they were to sell the company. So that really kind of concludes like how you would use the asset sale value in that aspect.
Yeah, so Ryan, you made a really, really great point there, that the value of the intangibles is not just going to be that financial figure that someone might have entered in the intangible assets field in our 7 steps. It's going to capture goodwill or client base and things like that. That's something we get a lot of questions about. So I think that's a really great point. And I know a lot of people get the asset sale value mixed up with the equity value. So do you mind talking about that one a little bit?
Yeah, absolutely. So again, this will be also a pretty important value, for all users, and it really represents the value to the shareholders. So, if we look at it from just a formulaic perspective, we've already calculated the asset sale value. So if we add in the cash, the accounts receivable, any other liquid financial assets, and then subtract any of the debt and liabilities, we're going to get to the equity value. So, how can we interpret this? Well, first, equity is going to be the prominent value when you're, setting up a stock sale, right? So like we said earlier, that's when you're going to be buying the equity in the company. So, as that implies, you're buying the equity, so you will use the equity value. Alternatively, let's say the deal is structured as an asset sale, right? So the value here would represent the portion that remains to the shareholders after they've collected, their cash and AR and paid off the liabilities. So just again, to give another example here, let's say we have a company that had, an asset sale of $500,000, right? So the business was going to sell for $500,000. And let's also assume that, there's 200,000 of cash and 100,000 of liabilities. So basically, that owner, the business is going to sell for 500,000. The owner is going to keep their 200,000 of cash. So now they have 700,000, and then they're going to turn around and pay off all their liabilities. So 600,000. So even though under the asset sale, it's sold for 500,000, the owner's really taking 600,000 home because they kept, cash and AR and paid the liabilities here. Now, there's going to be some more nuance there. There's going to be some transaction fees and things like that are going to, really change whatever the final amount is. But this is going to be, a pretty good general overview. So, logically, the next question is, well, when are the cases that I use the equity value? Well, again, in the event of a stock sale. So if you're buying or selling a business and it's going to be set up as a stock sale, then we're going to be focusing on equity value because, again, we're purchasing the equity into that company. It's going to be used frequently in litigation, so like matrimonial dissolution, things like that. Certainly useful in gift and estate planning, as equity value is the prominent value used in those as well. And it's also going to be, the reason you might set it up as a stock sale is that, they might be challenging and sometimes to transfer licenses, contracts, and other like key rights that belong to the business under an asset sale, right? So you might have to actually purchase into the entity. You have to purchase the equity in order to kind of avoid transferring those items.
Got it. So I know that the asset sale and the equity value are the ones that people focus on the most typically. Is that right, Ryan?
Yes, yeah, they're going to be the most prominent for users, especially in small business transactions.
Got it. Okay. And then I know, so the enterprise value, which we'll talk about now, this is more for middle market companies. Can you talk a little bit about that as well?
Yeah, so again, a term used frequently, but it can get a little bit more nuanced and complex. So, at a high level, this represents the value, the total value of a business's core operations to all investors in the company. So in order to calculate it, we're simply taking the equity value, we're going to subtract any cash and then add any long-term or interest-bearing debt to get to the actual enterprise value. So, how do we interpret this? What is it used for? Well, typically enterprise value is going to be used like we mentioned in middle market transactions. So once you start dealing with larger companies, that's when this is going to start getting used more often. So you'll hear it a lot with investment bankers, private equity, or any M&A participants. They frequently use this term, and they'll generally use enterprise value as a proxy for a potential takeover price into a company. So what you'd have to pay to all the equity owners and then anyone who's loaned the company money, right? So when we calculate the equity value, we know how much belongs to the actual shareholders, the owners, right? But if they financed, or got financing and part of the business is collateral, right? Some of that, creditors have the first, first take on, anything if the business were to default. So they have first rights. So again, we have to consider the value to them as well. So what we're really getting at with enterprise value is like the total value of the firm. So, if you just want to think about it simple terms, it's just the company's core business operations to all investors, meaning to both equity and debt holders. Now, some might wonder, okay, when would I use, equity, when would I use enterprise, or when would I use the asset sale value? And, they're actually pretty similar in a lot of ways. How you could, differentiate them is that enterprise value, again, is going to represent the core operations of the business, and it's mostly used in middle market transactions. Now, asset sale value represents the value of the business under the terms of a typical asset sale. And since most small businesses are going to transact as asset sales, they're going to therefore rely on the asset sale value, with middle market companies, again, relying on the enterprise values. Now, talking about some potential use cases. So, if you're speaking with a client, perhaps they are in the middle market, they're going to be using this to help negotiate, the price of, their company, as long as they're in the middle market. So we'll typically define middle market between 100 and 2,000 employees, and perhaps earnings of about 10 to 500 million. And another way, enterprise value is used often is it's good at comparing companies with different capital structures. So basically, since you're adding back the debt, you're kind of ignoring how they're financing the firm, and you have a better comparison, a better apples to apples approach, when you're looking at multiple companies. If we jump to the next slide here, we have a high level example. A lot of users, might question, why are we adding debt to the equity, right? It seems a little counterintuitive when you're getting to the value of the firm. But if you think about it like a home purchase, right? So in a home purchase, you have the home's value. Let's say you purchased a home and it's worth $500,000, right? And over the years, you have $200,000 of equity value in it, right? So if you were to sell it today, you would keep $200,000. Well, the rest of the mortgage, the amount that the bank owns is $300,000. So, together, between the equity, you as the shareholder of the home, the owner, and the value that the bank owns equals the home value. So that same concept can be thought of in enterprise value, right? So enterprise value is representing the total value of the firm. And it really is made up of, again, the equity value that we've already calculated, and then the long-term debt, the interest-bearing debt of the company. So what the creditors own of the company as well. So hopefully that provides a little bit more context. I know it's been helpful for me in the past to kind of see this illustration, and it really kind of gives you a little bit better understanding of why you're adding back debt in this transaction.
I completely agree, Ryan. This is one of my favorite ways to describe how equity value relates to both, again, enterprise and then asset sale value. So I love the house comparison. The last value in the BizEquity report is actually the liquidation value. So this is the one I'd say is used the least in most of our reports, but I think it is a really great conversation opener with your clients, saying, if you're not prepared with your valuation and for future events, you might only get this much for your business. But here, Ryan, I'll let you take it away with this one.
Yeah, and I would just echo that it probably will be used the least often, because what it really represents is, if you were to sell the assets individually in the market and then pay off the debt, what's left, right? And typically a liquidation value can be orderly or forced. So in an orderly liquidation, you have the time to take your assets to market and get the appropriate value for them. You're not really in a hurry. In a forced liquidation, you're really trying to sell the assets as quickly as possible, what is known as like a fire sale. So you're going to get pennies on the dollars for some of your assets. So you're not going to get the true value. Now, the value being calculated under the BizEquity software is closer to that of a forced liquidation. So it's really going to represent a worst case scenario, and really the floor value of the firm. So so again, here's the how it's calculated. We're really taking the fair market value of the tangible assets, and you're taking off any of the short and long-term liabilities, and that's what you're left with. Now, how might you use this? Well, again, if you're speaking to a client, like we just said, it really represents the floor value of their business. Many businesses, if it's a going concern, they're not going to transact in this way, because it really is a fire sale. So if you just need to get rid of the assets as quickly as possible. So again, not going to be mostly used, but still interesting to see for sure. And I think owners like that, to see what the worst case scenario is. But not really the highlight value that you're going to be looking at.
Yeah, definitely. So that's kind of a summary of the 4 different valuation estimates on the report. So we have the asset sale, the equity, the enterprise, and the liquidation values. Now, the ones that I think people use the most, and Ryan, correct me if I'm wrong, are the asset sale and the equity value. So Ryan wrote up a nice little comparison here, if you want to go over that as well.
Yeah, so as we discussed, basically, a lot of transactions when you're selling or buying a business, especially in small business, they're going to be structured as either an asset sale or a stock sale. So am I buying the individual assets of the company and I'm going to start my new entity and just pull all that stuff in there? Or am I going to buy, the equity, the stock into the company that I'm looking at, right? So basically, well, I'll just fill the shoes of the current owner. I'm keeping, the same entity, basically just the nameplate on the door is changing. Well, in an asset sale, the incoming buyers, they're purchasing the assets, they're getting the equipment, the inventory, the fixed assets, any intangibles of the company, and building it into a new entity. So during this, we're going to have what's called an allocation of purchase price under an asset sale. So it's really kind of a benefit to the buyer, right? So we're going to take the purchase price and we're really going to, chop it up, and we're going to apply part of the purchase price to each of the assets, right? So some of the purchase price is getting allocated to the inventory, some to the equipment, and then, whatever's remaining after the assets is going to go to goodwill. Now, why a buyer likes this is that, if I'm going to buy the business under an asset sale, I can, step up the basis in the fixed assets. So a little bit of accounting terms here, but I get to bring the value of that asset up to fair market value, so what I paid for it, and now I can redepreciate that asset. So even if the previous owner has already depreciated it and we're bringing it up, now we get the depreciation benefit as the buyer. So why that's helpful, early on is that, when I first take over this business, I'm trying to get used to the flow and running it. I can now, depreciate the asset, so I get that depreciation expense on my P&L, on my income statement, and it's going to lower my overall income. And then, obviously lower income means lower taxes in the earlier years. So buyers usually will prefer it for that reason. Now, in a stock sale, you're stepping into the shoes of the current company. So however, whatever their assets are at now for depreciation, you don't get to step that up, right? So a little bit less incentive, for an incoming buyer. Now, also under a stock sale, it's one of the more important things is that, if I buy in the equity of a company under a stock sale, I'm also inheriting all of their liabilities. So, one thing to think about is contingent liabilities. So we say known or unknown, right? So even if, I wasn't the owner during the time when, some event happened that caused the liability, I can still be responsible because I purchased the equity. I'm now the owner of that entity. So a little bit more risk there under the stock sale. That's why sellers will typically, or at least one reason why sellers will typically prefer it. It helps, kind of limit some of their exposure to the liabilities. Again, there's going to be no allocation of purchase price, so they can't step up the basis. And really, in some cases, it kind of makes sense for both parties to structure the deal as an equity sale, like we said before. Maybe you want to do it as an asset sale, but there's going to be some contracts or, maybe a large vendor, things like that, that you risk losing the contract if, you're just buying the assets and starting a new entity. They don't feel as comfortable. Whereas if you buy into the current company and you buy the equity from the owner, it's a little bit easier to transfer those contracts. So, just some little bit of nuances between these. Buyers will typically prefer the asset sale. Sellers will typically prefer the stock deal. So just kind of bringing it all back full circle, which ones are most important, right, for users? So, I think the asset sale value is going to be the most important for most of the users on here, right? So we're transacting in small businesses. We want to know the actual value, what it's going to sell for. That is going to be probably the prominent value that we're looking at here. So again, remember that's the value and under the terms of an asset sale. So we're just getting all the assets of the company. We don't keep the cash or AR or anything like that, or any of the debt. So that's how, or excuse me, just moving on. So stock sale. So again, in a stock sale, that's going to be where we buy the equity into the company, and that's going to be focusing on equity value. So moving to the second most important one, it's going to be that equity value. That's when we really care about that.
Got it. So I think you actually just answered one of the questions that we had received recently. So this is just another reminder. If you have any questions about anything that we just discussed, feel free to throw it in the chat in the GoToMeeting or the GoToWebinar panel. But one of the first questions we got was asked saying, you know, hey, I'm an advisor. I'm trying to help a business owner plan for retirement in a couple of years. What value should I focus on?
Yeah, so the value that everyone's going to want to focus on, so really asset sale and equity value are going to be important.
Mm-hmm.
So the asset sale value, remember, it's the value of the business, what it's going to sell for, but the equity value is what the owner's ultimately going to take home. So I think both of those are going to be very important to any user.
Yeah, definitely. Well, thank you for explaining all that. I think it, you know, every time you explain it to me, I understand it a bit more. So it's helpful having all of this in one place. Any other points that you'd like to bring up, Ryan? I think that you covered a lot of it already. I'm just waiting to see if there's any other chats that come in or questions.
Yeah, no, I think you know, it's really going to be, it depends on a lot, right? So there is going to be no one value that's appropriate. So it's really going to depend on the terms of what you're trying to accomplish. So just like we talked about the use cases, you know, if it's transacting just as a typical small business, that's going to be the asset sale value. If we're looking at, you know, a stock sale, trying to plan for tax purposes or litigation, things like that, we're going to be, you know, buy-sell agreement perhaps. We're going to be more looking at the equity value. Enterprise value is more in the middle market transactions. And then liquidation is really going to represent the floor value of the company.
Got it. Got it. And we did actually just get another question. So this one relates to how EBITDA filters into those calculations, especially EBITDA over time. Do you have any commentary on that?
Is there any like context? So how EBITDA, so EBITDA, I guess I'll just assume, you know, what they're asking here is how it filters into calculating the asset sale value at the beginning. So actually EBITDA and seller discretionary earnings are going to be very close, right? And our take is that, you know, really seller's discretionary earnings, you know, it's all the same add backs. It's essentially an adjusted EBITDA figure, right? And it's going to get to, you know, a very similar cash flow figure that EBITDA does as well. The other thing is that, you know, we're ultimately, you know, in theory, would end up at the same place because we're relying on multiples of sellers' discretionary earnings, which typically are lower because sellers' discretionary earnings as a cash flow figure is higher, right? Now, when we look at EBITDA, those multiples will be a little bit higher because the EBITDA will usually be lower than the SDE value. So even if you took an EBITDA figure times an EBITDA multiple, you should be getting to around the same spot as an SDE cash flow figure times by an SDE multiple.
Got it. And you say that, and does that help with the basis of, and let me just flip back to that slide, the asset sale value?
Yeah, so essentially you're going to get to that same place. So if you took either or, you would really be arriving at, you know, assuming you're looking at, you know, EBITDA multiples under an asset sale, you'd be arriving at the same figure.
Okay, got it. And another one, which we might have to do some research on and come back to, but someone asked, what is the approximate percentage of transactions that are stock versus asset sale? Do you have any insight on that?
I don't have the exact figure here, but the majority of small business transactions are going to transact as an asset sale for a lot of the reasons that we mentioned. It's a little bit cleaner of a transaction. You're going to start your own entity, and you don't have to worry kind of about any liabilities coming from the previous entity. And then a lot of, you know, current owners, they want to keep their, you know, cash AR and those types of things. So it's the predominant amount. We can get those, you know, a better figure for that, but the overwhelming majority are asset sale.
Definitely. So we'll see if we can follow up with a specific figure, but yeah, that makes sense. Now let me see if there's any others here. Don't believe I'm seeing any others come through. But if anyone does have any questions following up what we've talked about today, please feel free to shoot those over to us at support@bizequity.com, or you can call the number on the screen here. We're always happy to help. But definitely keep an eye out for that follow-up email. We're going to record, or we're going to include a recording of this webinar, as well as the slide deck, and then that white paper that I mentioned earlier. So yeah, thank you again, Ryan, for all of the knowledge that you've shared with the team today. And I hope it helps arm some of you guys for some of those conversations that you have with your business owners.
Yeah,
any last remarks, Ryan?
No, thank you everyone for joining.
All righty. Well, have a great day, everyone. We'll follow up shortly. Thanks again.